Okay, so everyone thinks America's economy may look unshakable, but the cracks are spreading fast. And when the pressure finally breaks, not every state will survive the hit. In 2025, warning signs are flashing everywhere. Rainy day funds already drained, households drowning in over $45,000 of average debt, and home values sliding tens of thousands of dollars in just months. Industries that once fueled local pride, manufacturing, energy, tourism, are cutting shifts, closing doors, and wiping out tens of thousands of jobs. Poverty in some regions now grips over 1 in 5 families, even before the downturn strikes. Housing markets that felt unstoppable are cooling into dangerous territory, leaving entire neighborhoods stretched thin. This isn't just a slowdown, it's the unraveling of financial stability across the map. If you want to stay ahead of the curve, make sure you subscribe right now, because what comes next could change faster than anyone expects. For some states, the margin for error is already gone. If a recession slams the U.S., they won't bend slowly. They'll snap hard. And the countdown has already begun. These are the 10 states most likely to collapse first, and you won't believe which one takes the top spot. Number 10, Kentucky. Kentucky looks calm on the surface. Cheap homes, green hills, and a cost of living lower than the national average. But looks can deceive. Beneath that charm, the state is standing on a financial trapdoor. Its rainy day fund covers only a sliver of what experts say is necessary, meaning one serious hit to tax revenue could trigger instant cuts to schools, hospitals, and emergency services. The job market isn't giving comfort either. While the U.S. sits at just above 4% unemployment, Kentucky is already higher, and that's before the recession even lands. Factories in autos, coal, and agriculture are slowing, and when those industries cough, entire towns start to choke. Then comes the number that should worry everyone. Nearly 1 in 5 Kentuckians already lives below the poverty line. That's twice the national average. For those families, there's no backup plan, no safety net. A small drop in income could mean losing homes, skipping medical care, or sliding into debt they can't escape. And the housing market isn't offering rescue. Prices in Louisville and rural counties are slipping, shrinking home equity that many rely on as their only cushion. Once that lifeline breaks, thousands could find themselves owing more than their house is worth. GDP growth is already shrinking, showing that Kentucky's dependence on fragile industries is dragging it down early. Put it all together and the picture is clear. Thin reserves, rising unemployment, deep poverty, and an economy losing steam. Kentucky won't just bend in a recession, it could be one of the first states to snap. And if you think that sounds bad, wait until you see what's happening in a tiny coastal state with even less room to breathe. Number 9, Rhode Island. It may be the smallest state in America, but Rhode Island's recession risks are anything but small. With just over 1 million people, the tax base is narrow, and that makes every dip in revenue cut deeper than it should. The rainy day fund is thin, covering only a fraction of yearly expenses, well below what experts say is safe. One budget shock, and the state would be scrambling. Jobs are another flashing red light. In early 2025, unemployment crept past the national average, with layoffs hitting healthcare and tourism, the very industries Rhode Island leans on most. When those sectors stumble, the ripple isn't small. It spreads across the state like wildfire, because there aren't many other industries to soften the blow. On the household level, the strain is brutal. The median home price is over $440,000, far higher than what most local incomes can support. Families here carry heavy debt loads, averaging above $40,000 per person, with rising delinquencies showing just how thin the margin has become. Add in long-term pension obligations the state has struggled to fund, and the pressure builds on both sides, families and government. So while Rhode Island may look quaint and stable from the outside, it's standing on a very fragile foundation. In a nationwide downturn, this tiny state could be one of the first to tip over. Not with a loud crash, but with a quiet slide that nobody sees coming until it's too late. Number 8, Idaho. For years, Idaho was one of America's fastest growing states. Families moved in droves, businesses expanded, and home prices skyrocketed. But that boom has turned into a dangerous setup. The population surged nearly 20% in just over a decade. And housing markets, especially around Boise, nearly doubled in value between 2019 and 2024. Now the bubble is showing cracks. Listings are piling up, inventory jumped by double digits, and sellers are slashing prices just to stay in the game. Families who bought at the peak are trapped with mortgages they can barely afford. With national home sales slowing to their weakest pace in 3 decades, Idaho's reliance on real estate has become a liability, not a strength. The job market adds more pressure. Unemployment, while not the highest in the country, has begun to creep up as construction cools and tech layoffs ripple through. Agriculture, another backbone of Idaho's economy, is also highly sensitive to global downturns. When demand shrinks, entire communities feel the shock. And here's the real risk. The state's reserves cover only a sliver of annual spending. If tax revenue dries up, schools, infrastructure, and public services could face cuts almost overnight. For a state that grew on the promise of opportunity, Idaho now looks dangerously overexposed. It's the classic boom-to-bust story, but this one isn't finished yet. And the next state on the list proves that even endless sunshine can't keep the storm away. Number 7, Arizona. Arizona has been a magnet for retirees, remote workers, and families fleeing high-cost states. But behind the desert sun lies a storm building fast. The median home price has soared past $420,000, and in hotspots like Phoenix and Scottsdale, it's well above $500,000. Meanwhile, the average household income lags far behind, leaving nearly 1 in 3 families officially housing burdened, spending more than 30% of their paycheck just to keep a roof overhead. That imbalance was manageable in boom times, but now the cracks are clear. Unemployment is climbing, creeping higher than the national average, with layoffs in tourism, retail, and construction already underway. Phoenix alone has shed tens of thousands of jobs in just months, and when the lifeblood of service industry slows, the whole economy stumbles. Arizona's rainy day fund is another weak spot. It sits well below the level economists recommend to ride out a recession. That means state leaders won't have the cash to soften the blow if tax revenue drops, leaving cuts to public services almost unavoidable. Add in rising personal debt, with delinquencies on auto loans and credit cards ticking upward, and households are one unexpected bill away from collapse. Arizona's growth made it look unstoppable, but in a downturn, the very factors that fueled its rise, population booms, real estate speculation, and service-heavy jobs, turn into liabilities. The desert heat can hide a lot, but it can't hide this. Arizona is already sweating, and a full-blown recession could push it over the edge. And if Arizona looks risky, the next state is even more fragile, because its entire economy has always been one big gamble. Number 6, Nevada. Nevada has always lived by the gamble, and in 2025, the odds are starting to turn against it. The state depends heavily on gaming, entertainment, and tourism, industries that crumble the moment consumer spending slows. Already, Las Vegas has seen visitor numbers drop by over 11% year over year, a chilling sign for a city where hotel rooms, casinos, and conventions are the lifeblood of the local economy. That drop hits more than the Strip. Sales taxes and gaming revenues make up a huge share of Nevada's budget, and when tourists stop spending, the state's finances immediately feel the strain. With one of the thinnest rainy day funds in the nation, Nevada has almost no room to cushion the blow. The housing market tells the same story. Pandemic investors rushed into Vegas real estate, driving prices up. But now listings are stacking up and values are slipping. Nearly 1 in 5 homeowners in the Las Vegas metro is already underwater, owing more than their homes are worth. Add in consumer debt averaging well over $45,000 per household, and the pressure on families is intense. Unemployment is climbing too, with tens of thousands of jobs already lost in hotels, casinos, and entertainment venues. And once those positions disappear, recovery is slow, because the entire state leans on the same few industries. Nevada is proof that when your economy is built on luck, it only takes one bad hand to lose it all. And if Vegas is rolling snake eyes, the industrial heartland of America may be next in line for collapse. Number 5, Indiana. Indiana calls itself the crossroads of America, but right now those crossroads are looking more like a dead end. The state's economy is built on manufacturing, autos, steel, and machinery, and those are exactly the sectors that get hammered first when recessions hit. In 2025, factory output is already slipping, with orders slowing and major employers trimming shifts. That means tens of thousands of workers are suddenly on edge, wondering if their paycheck will be next. Unemployment is rising, and workforce participation has sunk to its lowest point in a decade. For a state that prides itself on being the backbone of American industry, that's a dangerous signal. And Indiana doesn't have the reserves or the social safety net to soften the fall. Public health spending ranks near the bottom nationally, and unemployment benefits are among the stingiest in the country. Household finances are cracking too. The median income hovers just above $63,000, while debt has surged past $40,000 per household, climbing sharply in just a few years. Families here don't have much wiggle room, and when factory hours disappear, debt piles up fast. Housing isn't offering relief either. Prices in cities like Indianapolis and Gary are flattening, vacancies are rising, and evictions are up. Renters, who make up nearly a third of the population, are being squeezed hardest as wages stall and costs climb. Indiana's strength, its factories, has become its greatest weakness. When the assembly lines slow, the entire state economy slows with them. And this time, the brakes are already screeching. But while Indiana risks stalling, the next state looks like a rising star until you dig beneath the surface and see how fragile its foundation really is. Number 4, South Carolina. South Carolina has been selling the dream. Booming cities, coastal charm, and a flood of new residents bringing money and growth. But beneath the shine, the numbers tell a different story. The median home price has climbed to nearly $390,000, a staggering 50% jump in just a few years. Yet the median household income is barely above $63,000. That mismatch leaves tens of thousands of families on the edge, spending far more on housing than they can truly afford. Tourism and real estate have fueled much of the state's rise, but both are slowing. Visitors to Charleston and Myrtle Beach are pulling back. Construction starts are dropping, and developers are slamming the brakes. GDP growth has already stalled close to zero, hinting that the boom is losing momentum. South Carolina's rainy day fund is thin, covering only a fraction of annual spending, and public services are already stretched. The state ranks near the bottom in education funding and healthcare access, meaning there's little cushion if layoffs snowball. And layoffs are already here. Tens of thousands of jobs have vanished in hospitality, construction, and retail in just months. Debt only adds to the strain. Average households owe more than $43,000, and credit card delinquencies are rising, proof that families are patching over daily expenses with borrowed money. When that stops working, the crash comes fast. South Carolina may look like a growth story on the outside, but when a recession bites, the Palmetto State could unravel quicker than almost anyone expects. And if you think that's shaky, the next state doesn't just struggle with growth or jobs, it struggles with poverty on a scale no other part of America can match. Number 3, Mississippi. Mississippi has long ranked at the bottom in national surveys of wealth and resilience, and in 2025, the gap has only grown wider. Nearly 1 in 5 residents lives below the poverty line, the highest rate in the country. That means entire communities are already stretched to the breaking point even before a downturn begins. For them, a recession isn't just an economic dip, it's survival on the edge. The state's rainy day fund is among the weakest in America, covering only a sliver of annual spending. That leaves little to protect schools, hospitals, and infrastructure if revenues collapse. And infrastructure is already crumbling. More than 1,000 bridges are structurally deficient, and water systems in cities like Jackson remain in crisis. When a recession hits, the money to repair or even maintain these essentials could vanish overnight. Jobs aren't offering relief either. Unemployment is climbing, factories and farms are slowing, and rural hospitals are closing at alarming rates. With limited healthcare access and chronically underfunded education, Mississippi's ability to bounce back is almost non-existent. Households are struggling too. Median income sits just above $51,000, while average debt per household climbs past $38,000. Rising costs of energy and insurance are squeezing families further, leaving many with nothing left to cut. Mississippi isn't just vulnerable to recession, it's already on the cliff's edge. One strong push from a nationwide downturn could send the state into a spiral that would take years, maybe decades, to escape. But while Mississippi's weakness comes from poverty and neglect, the next state faces a very different threat: the dangerous side effects of rapid growth and sky-high living costs. Number 2, Colorado. Colorado was once a symbol of endless growth: tech startups in Denver, booming real estate in Boulder, and tourism flooding the ski towns. But in 2025, that success story is starting to show dangerous cracks. The median home price sits above $540,000, and in Denver it's even higher, despite prices slipping by several percentage points in the last year. For many households, wages simply can't keep up. Nearly 4 in 10 homeowners are cost-burdened, trapped by mortgage payments that eat up their income. The labor market is wobbling too. Layoffs are hitting tech, construction, and tourism, the very industries that built Colorado's reputation as a growth darling. Unemployment is climbing past the national average, and GDP has already contracted. Add in rising consumer debt, averaging close to $49,000 per household, and it's clear families are leaning on credit cards and loans to keep their lifestyle afloat. Reserves aren't deep enough to catch the fall either. The state's rainy day fund is below national benchmarks, leaving little buffer if tax revenues collapse, and public services are already stretched. Colorado ranks near the bottom in education funding, while homelessness is surging in urban areas. What makes Colorado's position even more precarious is the illusion of stability. On the surface, it still looks like a thriving state with booming cities and mountain tourism. But beneath, high costs, rising debt, and shallow reserves leave it fragile. If the recession lands hard, Colorado's picture-perfect economy could unravel faster than most expect. And if that seems harsh, wait until you see the state that takes the #1 spot. A place where poverty, weak finances, and collapsing industries collide in a perfect storm. Number 1, Louisiana. Louisiana doesn't just risk struggling in a recession, it risks total collapse. The state sits at the bottom when it comes to financial preparedness. Its rainy day fund covers less than 5% of annual spending, the lowest in the nation. That means if tax revenues plunge, Louisiana could keep the lights on for only a few weeks before the budget unravels. Jobs are already vanishing. Unemployment has jumped higher than the national average, with more than 50,000 positions lost in just months. Industries that once powered the state, oil and gas, shipping and tourism, are all taking hits. Offshore drilling has slowed, New Orleans has seen its hospitality workforce shrink, and construction projects across Baton Rouge have come to a halt. For families, the situation is even bleaker. The median household income hovers around $54,000, while nearly 1 in 4 residents lives in poverty. Rents and insurance costs are climbing, flood risks are rising, and more than 40% of renters are considered severely cost-burdened. With households already weighed down by over $42,000 in average debt, there's no safety net left to rely on. Infrastructure makes the picture worse. Roads, levees, and water systems are underfunded, and storm damage keeps piling costs onto communities that can't afford them. When recession pressure meets physical vulnerability, the results aren't gradual, they're catastrophic. Louisiana isn't just another fragile state, it's the one most likely to fall first, and hardest if the U.S. economy plunges. And that brings us to the bigger question. If the Bayou State goes under, how many others will follow? The warning signs couldn't be clearer. From Kentucky's weak reserves to Louisiana's collapsing industries, each of these 10 states carries fault lines that a recession could tear wide open. Some will struggle but manage to bend, while others may snap under the weight of poverty, fragile budgets, and overstretched households. The truth is, recessions don't hit every state the same way, and what we're seeing now are the early tremors of a much bigger quake. The question is, which state do you think is most at risk and why? Drop your thoughts in the comments because your take might just reveal the next state we need to watch. And if you want to stay ahead of the curve with deep dives like this, make sure you hit subscribe right now. That way you won't miss the next breakdown when we uncover the hidden cracks shaping America's future.